What is happening, crypto enthusiasts, and welcome back to Bitcoin Bulletin. The digital asset space is moving at lightning speed, and if you're not plugged in, you're missing out on massive shifts. Today, we've got some blockbuster news that could redefine how major players interact with the crypto world. Get ready, because the updates are hot, the implications are huge, and you absolutely need to know what's going down. From tech giants making strategic moves to traders bracing for seismic price swings, this is the information that will keep you ahead of the curve. Don't blink, you might miss the next big thing. Let's dive right in. First up, a tech titan might be dipping its toes into the Bitcoin mining pool. Could Alphabet, the company behind Google, be preparing to mine Bitcoin? We're talking about significant financial commitments and warrants that could lead to a substantial equity stake in a major mining operation. This isn't just a casual investment, it's a strategic play that has the crypto community buzzing. We'll break down exactly what this means and why it's a game changer. Then, we're hitting the markets with some serious volatility. Panicked traders are bracing for massive price targets for both Bitcoin and Ethereum, with fears of a significant crypto price gripping the market. We're seeing projections of $100,000 Bitcoin and $4,000 Ethereum, but what's driving this fear, and is it justified? We've got the inside scoop on the market sentiment and the potential catalysts for these dramatic shifts. Next, we're looking at the big picture of how Wall Street is embracing crypto, and it's a story of Bitcoin leading the charge, but Ethereum is definitely trying to catch up. We'll explore the corporate treasury plays unfolding, with major companies allocating significant portions of their reserves to digital assets. Discover which companies are leading the pack and how this trend is reshaping traditional finance. And finally, Bitcoin has seen a notable dip from its all-time high. Is this a temporary pullback, a healthy correction, or a sign of deeper trouble? We're analyzing the data, looking at historical trends, and assessing whether this is a prime buying opportunity or a moment for investors to exercise caution. Stick around, because these are the updates you can't afford to miss. Hit that like button, subscribe, and ring the notification bell so you never miss an episode. Tech giant explores Bitcoin mining. Could Alphabet, the parent company of Google, be on the verge of entering the Bitcoin mining arena? Recent developments suggest a significant strategic move where Alphabet has agreed to backstop lease obligations at a New York data center campus operated by TeraWulf, a prominent Bitcoin mining company. This agreement comes with a crucial component: stock warrants that could translate into a meaningful equity stake in TeraWulf, potentially giving Alphabet around a 14% ownership if exercised. This isn't a direct purchase of Bitcoin or an outright acquisition of a mining firm, but the economic exposure for Alphabet is substantial enough to warrant close examination by investors. The specifics of the deal involve Alphabet supporting long-term lease commitments for an expansion at TeraWulf's Lake Mariner campus near Buffalo, New York. In exchange for this commitment, which cumulatively totals approximately $3.2 billion, Alphabet has been granted warrants. These warrants, if exercised, would increase its stake in TeraWulf. While this figure is a small fraction of Alphabet's vast cash reserves, exceeding $95 billion, it signifies a deliberate, albeit minor, strategic engagement with the digital asset infrastructure. It's important to clarify that Alphabet is not acquiring Bitcoin directly on its balance sheet, nor would exercising these warrants imply direct ownership of the cryptocurrency. Instead, the move appears to be a calculated decision to gain exposure to the necessary data and computing infrastructure at an industrial scale. The Bitcoin mining activities of TeraWulf are likely viewed as incidental to the broader infrastructure services Alphabet requires. By securing an equity stake, Alphabet positions itself for participation in the economics of Bitcoin through its investment in a key player in the mining ecosystem. The value of companies like TeraWulf is intrinsically linked to the price of Bitcoin and their mining efficiency. Therefore, an increase in Bitcoin's price would directly enhance TeraWulf's valuation, consequently boosting the value of Alphabet's potential stake. This development offers a subtly positive signal for Bitcoin holders. The comfort of a megacap technology company in seeking indirect exposure to Bitcoin's market dynamics via a mining operator helps to normalize the asset class for other large corporations, considering their own entry strategies. Alphabet's willingness to engage with warrants from a Bitcoin miner implicitly suggests a belief in the underlying asset's value and future potential. However, this should not be interpreted as a strong buy signal for Bitcoin itself. Even with the exercise of warrants, Alphabet is unlikely to become a dominant force in Bitcoin mining. Rather, this event reinforces a growing trend. Sophisticated, large-cap companies are increasingly seeking equity-based exposure to the Bitcoin ecosystem, even when their shareholders might be hesitant about direct Bitcoin holdings. This adds another layer of confirmation to the ongoing bullish sentiment surrounding institutional adoption. Hold on tight, because the market sentiment is shifting dramatically. Next, we're diving into the panic-hitting traders, as Bitcoin and Ethereum prices face a potential crash. Traders brace for $100,000 Bitcoin amid crypto crash fears. The cryptocurrency market is experiencing a wave of anxiety as traders prepare for significant price volatility, with some projecting Bitcoin to reach $100,000 and Ethereum $4,000, while fears of a broader crash intensify. This sentiment follows a notable flash crash that saw Bitcoin's price plummet by $4,000 in mere minutes, occurring shortly after a prominent Harvard economist acknowledged his past misjudgment of Bitcoin and cryptocurrencies. The downturn has persisted, with Bitcoin's price continuing its downward trend after a brief boost from comments made by Federal Reserve Chair Jerome Powell. This slump has even raised concerns about the viability of new cryptocurrencies, such as Kanye West's recently launched digital currency, which has reportedly fallen 80% from its all-time high. Further exacerbating the market's unease, the Bitcoin price has remained under pressure, with a flash crash sending it spirally lower. Other major cryptocurrencies, including Ethereum and XRP, have also seen substantial declines, collectively losing approximately $100 billion in value. This downward movement has pushed Bitcoin below the $110,000 mark for the first time since early July. Notably, the price drops in Ethereum, XRP, and other leading cryptocurrencies have outpaced Bitcoin's decline. This market behavior comes after Federal Reserve Chair Jerome Powell's earlier remarks had initially propelled Bitcoin's price higher by signaling openness to an interest rate cut in September. Market analysts are divided on the immediate future. David Hernandez, a crypto investment specialist at 21 Shares, suggested that the latest personal consumption expenditures inflation data could either drive Bitcoin back towards $120,000 or further stall its momentum. Sean Dawson, head of research at options platform Derive, Zeiss, observed a distinct shift in market sentiment. He noted that the 25 delta skew for both Bitcoin and Ethereum has turned negative, indicating a stronger preference for put options, bets on price declines, over call options, bets on price increases. This represents the most significant demand for downside protection seen in 2 weeks, with traders actively preparing for potential retests of $4,000 for Ethereum and $100,000 for Bitcoin. Dawson estimates a 35% probability of Bitcoin crashing back to around $100,000 by the end of September, a notable increase from the previous 20% estimate, and places the probability for Ethereum dropping to $4,000 at 55%. He warns that increasing macro pressures and spiking volatility are causing rapid market resets, potentially leading to a bumpier ride than many anticipated. The sudden decline in Bitcoin has been attributed by some social media reports to a single large holder liquidating approximately 24,000 Bitcoin, valued at over $2 billion. Jacob King, a Bitcoin and crypto market analyst and CEO of Whalewire, stated that this flash crash, which erased $310 million in long positions, was linked to a major Bitcoin whale selling off a significant portion of its holdings, including coins that had been dormant for over 5 years. This entity reportedly transferred over 12,000 Bitcoin to the Hyperunite trading platform alone. While some market observers point to the single seller, others suspect coordinated actions, possibly involving institutional players. Vincent Liu, chief investment officer at Chronos Research, believes it's more likely the result of multiple large holders or even an exchange with substantial holdings rather than a solitary entity, suggesting that such large-scale transactions often involve institutional players or coordinated efforts. But is this market panic a sign of things to come, or just a temporary blip? Now, let's shift our focus to how major companies are strategically building their crypto treasuries, with Bitcoin leading the charge. Bitcoin dominates corporate treasuries. Ethereum plays catch-up on Wall Street. Bitcoin, BTC USD, continues to assert its dominance as the premier asset for corporate treasury allocations. But its counterpart, Ethereum, ETH/USD, is rapidly emerging as a strong contender in this evolving financial landscape. Companies are increasingly diversifying their reserves by incorporating cryptocurrencies, with Bitcoin still holding the top spot due to its established market presence and perceived store-of-value properties. However, the growing adoption of Ethereum by various corporations signals a significant shift in how digital assets are being integrated into traditional financial strategies. Leading the charge in Bitcoin treasury adoption is MicroStrategy, under the guidance of Michael Saylor. As the largest cryptocurrency treasury company globally, MicroStrategy holds an impressive $69 billion worth of Bitcoin in its reserves, according to CoinGecko. Following this lead, major Bitcoin mining companies like MARA Holdings and Riot Platforms have also significantly increased their Bitcoin holdings, accumulating reserves valued at $5.57 billion and $2.11 billion, respectively. Even Trump Media, a company with substantial ties to former President Donald Trump, has entered the fray, with its current Bitcoin reserves exceeding the $2 billion mark. Collectively, public companies now hold a staggering 1,936 BTC, valued at approximately $110.25 billion, which represents 4.77% of Bitcoin's total circulating supply. This substantial allocation highlights Bitcoin's growing acceptance as a legitimate treasury asset. The adoption of Ethereum for corporate treasuries, while slower to gain traction, has seen a remarkable surge in momentum over the past 2 months. A growing number of small-cap companies have begun to embrace ETH as their primary reserve asset. Bitmine Immersion Technologies, guided by prominent Wall Street strategist Tom Lee, has rapidly ascended to become the largest Ethereum treasury company. It also ranks as the second-largest cryptocurrency treasury overall, trailing only MicroStrategy, with reserves surpassing $7.5 billion. This significant position has attracted notable investors such as Cathie Wood and Peter Thiel, who have acquired substantial stakes in the firm. SharpLink Gaming has also made a considerable commitment, holding $3.2 billion in ETH reserves, while the newly established ETHZilla, also backed by Peter Thiel, has amassed over $450 million in ETH. Currently, public companies hold a total of 2,984,248 ETH, valued at $13.22 billion, accounting for 2.7% of the total ETH in circulation. This figure is roughly 12% of the total amount of Bitcoin held in corporate treasuries, indicating a significant, albeit still secondary, role for Ethereum. At the time of reporting, Bitcoin was trading around $110,152, reflecting a 2.37% decrease in the last 24 hours, according to Bitcoin Bulletin Pro data. Ethereum, meanwhile, experienced a more pronounced decline, trading down 5.93% to $4,433. The market performance of related stocks also reflects these trends, with MicroStrategy shares sliding 0.64% in after-hours trading after a 4.17% drop during the regular session. Similarly, Bitmine Immersion Technologies, BMNR, stock closed down 7.27%. MicroStrategy's stock, in particular, has demonstrated very high momentum scores, underscoring its strong performance in the market. For investors looking to navigate this space, the Bitcoin Bulletin Edge stock rankings offer vital metrics to evaluate the performance of these cryptocurrency treasury firms and identify the best fit for their portfolios. As these corporate treasuries grow, the market is watching closely for the next big move. Now, let's analyze Bitcoin's recent price action, Is this dip a buying opportunity, or should investors be wary? Bitcoin's post-high dip, buying opportunity or cautionary signal? Bitcoin, BTC, has experienced a notable pullback, dropping nearly 12% from its all-time high of $124,457 reached on August 13th. After a brief recovery, the price has continued to slide, settling around the $110,000 mark. This decline has naturally led many crypto investors to question whether the current rally has concluded or if further upside potential remains. To address these concerns, a closer examination of the data and historical trends is essential. It is crucial to remember that cryptocurrencies are inherently volatile assets, characterized by significant price swings on a monthly, weekly, and even daily basis. A 12% decline is not an anomaly. Historically, Bitcoin rallies have often been accompanied by corrections of 30% or more. When viewed from a broader perspective, Bitcoin's performance remains strong. It is up 17% year-to-date and has seen a remarkable 70% increase over the past year, demonstrating robust long-term growth. Furthermore, historical data indicates that Bitcoin typically experiences a cooling-off period in August and September before regaining momentum towards the end of the year. For instance, in 2024 and 2023, Bitcoin experienced declines in August, followed by substantial triple-digit percentage gains for the remainder of the year. This historical pattern suggests that the current dip might be a seasonal trend rather than a sign of fundamental weakness. To further assess the market's health, various indicators are being monitored. CoinGlass, a crypto data and information provider, tracks 30 bull market peak indicators for Bitcoin. Currently, none of these indicators are signaling a red flag, which should provide some reassurance to investors. While some indicators, like the Pi cycle top indicator, are technical and can be complex, others offer more straightforward insights for long-term investors. One such indicator is days of ETF net outflows. This metric tracks consecutive days of net outflows from spot Bitcoin exchange-traded funds, ETFs. A sustained outflow period of 10 days or more is considered a warning sign, indicating potential panic selling. As of now, this indicator stands at only 6 days, suggesting that investor sentiment has not yet reached a critical level of concern. The narrative surrounding Bitcoin is increasingly shifting, with proponents arguing that the market dynamics have fundamentally changed. They contend that Bitcoin, once a highly speculative, retail-driven asset prone to extreme volatility and cyclical collapses, has now matured. The argument is that institutional investors, known for their long-term perspective and reduced susceptibility to panic selling, are now providing a stabilizing influence. Additionally, the perceived pro-crypto stance from the U.S. government is cited as a factor that could smooth out the historical 4-year Bitcoin cycle, paving the way for sustained price appreciation. However, a cautious perspective remains warranted. The "this time it's different" mentality, as famously warned by investor John Templeton, can be dangerous in financial markets. While institutional adoption and technological advancements may alter Bitcoin's trajectory, historical patterns, particularly the 4-year halving cycle, cannot be entirely dismissed. The last Bitcoin halving occurred in April 2024, and historically, the most significant price appreciation phases have lasted up to 18 months post-halving. Given that we are approximately 16 months into this cycle, it is plausible that the bull market rally could be approaching its peak. Investors overly focused on ultra-bullish predictions, such as a $1 million Bitcoin price target, might be overlooking this critical historical data. Therefore, while the current dip could present a prime buying opportunity for those who believe the cycle is fundamentally changing, investors who remain tethered to historical data might prefer to wait for greater market clarity. So, is it time to buy the dip, or is caution the better part of valor? Let's quickly recap the biggest stories we've covered today, and make sure you're subscribed so you don't miss any future updates. Alright, let's do a lightning round recap. Alphabet might be getting into Bitcoin mining through strategic warrants with TeraWulf. Traders are bracing for major price swings, with $100,000 Bitcoin and $4,000 Ethereum targets appearing amidst crash fears. Corporate treasuries are booming, with Bitcoin leading the charge, though Ethereum is making significant gains. And finally, Bitcoin's recent 12% dip from its all-time high has investors debating whether it's a buying opportunity or a signal to stay wary. Don't miss any of these critical updates. Hit that like button, subscribe to Bitcoin Bulletin, ring the notification bell, drop a comment below with your thoughts, and follow us on all social media platforms for real-time insights. We'll see you in the next one.